Welcome to the Pro Ticker Deep Dive. Today we're diving into the global macro picture for September, and honestly, looking at the situation, the global economy is, well, it's giving us a really complicated diagnosis.
It really is.
We're kind of living in this market defined by contradictions, aren't we? You've got the consumer, say, in the US, staying surprisingly resilient, but then global manufacturing has just stalled out, and policymakers, they seem completely divided on the next steps.
That tension is exactly why this deep dive is so important right now. We've got this world sort of straddling low growth stagnation on one side, and then these tentative signs of internal stabilization on the other.
Right.
So our mission for you, the listener, is really to cut through that noise. We need to answer the big question. Are we stuck in a long patch of policy confusion and, sputtering growth? Or is there something else going on? Are the fundamentals quietly building a solid, maybe modest, but solid foundation for some kind of rebound?
It really feels like the market is just bouncing around based on whatever the last data point was. One week it's recession canceled, the next week, oh, we're worrying about inflation again.
Precisely. And the core message, when you synthesize everything, is pretty clear. The global economy is, thankfully, resilient enough to avoid a total collapse.
Okay, that's something.
But it's way too uncertain to generate a clear boom. So you should really be prepared for a choppy, kind of sideways environment.
Sideways. Okay.
Yeah, where volatility is mainly driven by sharp reactions to surprising data, those mixed signals from central banks, and, of course, any big news on trade.
Okay, let's unpack this. Let's start where things feel maybe the most challenged right now, Europe. We've been tracking Europe, and it continues to be defined by what you might call stubborn stagnation.
It really is that classic tale of two economies over there. If you look at the business activity surveys, services, think restaurants, consulting, local shops, that's the only thing keeping the overall economy barely in positive territory.
Just barely.
Just barely. But manufacturing, it's acting like a huge anchor, a massive drag. And that split makes policymaking incredibly difficult, almost impossible, you could say.
And nothing really shows that fragility better than Germany, does it? The regional powerhouse.
Go ahead.
We saw their business climate indicators actually weaken again, right?
Sure.
Reversing months of, well, hard-fought, tentative improvement.
It tells you the recovery, whatever it is, isn't self-sustaining yet. Not by a long shot.
And that sluggishness, you see it directly in how people feel, in household psychology.
Absolutely. Consumer sentiment across the Eurozone has barely budged. It's just sitting stubbornly well below the historic averages. It signals that the average European household is nervous. They're not confident enough about their job, their future income, to really start spending big on the things needed to kickstart a proper broad recovery.
So if growth is this slow, you'd normally think, okay, central banks will jump in, cut rates, try to stimulate things. But the inflation picture is more complicated, isn't it?
It is. It's the central banker's nightmare, really. Inflation dynamics are, let's say, mildly firmer than those weak growth figures might suggest.
Okay.
Now, the huge energy cost drag from last year is easing, thankfully, but September inflation readings, they're still expected to tick up slightly above 2%.
And what's driving that?
Services inflation is the real culprit. It's proving sticky, mostly reflecting those embedded wage dynamics and, high fixed costs for businesses.
So that 2% reading, it acts like a roadblock. It's just high enough to stop aggressive growth-focused rate cuts,
Exactly.
but obviously not strong enough to make the central bank pivot back to hiking rates again. They're kind of strategically paralyzed.
That's the perfect definition of the central bank tight spot. They're forced to be cautious, balancing weak growth against this sticky core services inflation. But, and here's the glimmer of light, maybe we are seeing some tentative improvement in financial conditions. That could connect back to future activity.
Oh, interesting. Tell us more about that. What specific financial conditions are looking better?
Well, we're seeing reports that banks are starting to implement less restrictive lending standards.
Okay, so credit might flow a bit more easily.
Potentially, yes. And critically, money supply growth has actually turned positive again.
Now, for our listener, why is positive money supply growth important? Why does that matter?
Well, it basically means capital is finally starting to circulate in the real economy again, after a long period where banks and businesses were, essentially hoarding cash or paying down debt.
Right.
So when the money supply starts growing, it suggests financial conditions are easing enough to maybe support business and consumer activity down the line. perhaps into 2026 even.
Okay, a glimmer of hope there from easier financial conditions. But we also have to look at fiscal policy, especially in places like Italy, which has been walking this incredibly narrow fiscal tightrope.
Yes, Italy is fascinating here, especially how the market is interpreting its plan. The government has signaled it intends to rein in its deficit quite aggressively.
Right, aiming for around 3% of GDP by 2025, I think, even with growth forecasts softening.
Exactly. Now, that sounds tough politically, maybe even counterproductive for growth in the short term, but the market seems to view it positively.
Why would reducing the deficit, which could limit stimulus, be seen as market-friendly? That seems counterintuitive.
It mostly comes down to a technical change that gives them a lot more breathing room. While Italy's overall debt level is still extremely high, no question. Huge. But recent revisions to how they calculate nominal GDP mean the starting point for the debt-to-GDP ratio is actually lower than everyone thought.
Okay, so the denominator changed favorably.
Precisely. It lowers the long-term risk premium that bond investors demand. It signals that even if growth slows, the government is taking prudent steps to manage its solvency. And that helps stabilize their borrowing costs, which is key.
That's a really powerful insight into how markets view fiscal discipline, even with weak growth. Okay, let's shift gears. Let's jump across the Atlantic. The U.S. economy, it seems strong on the surface, maybe stronger than Europe, but the sources suggest this strength might be hiding some underlying weaknesses. What does that cocktail of contradictions look like?
Well, the surface strength has been pretty impressive, you have to admit. Q2 GDP, for instance, got revised sharply higher, came in near 4% growth.
Wow, nearly 4%.
Yeah, driven by pretty robust consumption and solid business investment.
Yeah.
And then you saw durable goods orders bouncing back strongly in August. That suggests businesses are still committing capital to equipment to technology.
Even the housing market perked up a bit, didn't it? Lower mortgage rates seemed to boost new home sales for a while.
It did. But the critical question you have to ask is, was that Q2 strength sustainable? Or was it more like a final burst? Maybe fueled by the last bits of pandemic savings running out.
That's the million-dollar question. What does the evidence suggest?
The evidence suggests it was robust, yes, but that the momentum is definitely fading now, and fading where it matters most, the labor market.
Oh, okay. The jobs picture.
Job growth has slowed down significantly. It's down to levels that are barely enough to keep the unemployment rate from ticking higher. The pace of hiring has cooled considerably.
So Q2 growth was real, but the engine underneath consumer confidence built on job security that's starting to sputter.
That's a good way to put it, sputtering.
Mm.
And you see that cooling labor market hitting consumer psychology directly.
How so?
Consumer confidence dipped noticeably in September. It reflects that nervousness you'd expect, right? People see headlines about hiring slowing down. They still worry about inflation eating into their wages.
Yeah, real wage worries.
Exactly. That dip tells us the cracks beneath the surface, they're starting to bother the average household now.
And then, layered on top of all this domestic stuff, we have that geopolitical X factor. A new round of tariffs kicking in around the start of October, targeting sectors like pharma, trucks, furniture.
Yeah, this is a major immediate headwind. Now, large domestic companies might be somewhat insulated, but these tariffs, they really threaten to weigh on global trade volumes. They disrupt supply chains that are already, a bit fragile.
And eventually hit consumers and businesses.
Eventually, yes. Higher costs for consumers, tighter margins for businesses.
Who gets squeezed the hardest by this kind of trade friction?
Well, typically it's the smaller companies, the ones who can't easily just switch their sourcing overnight. And critically, our close trade partners, Mexico, Canada, Japan, they're deeply woven into U.S. supply chains.
And the risk of retaliation is always there, I suppose.
Always. Which could just make everything much worse, much faster, especially for those supply chains.
Okay, this brings us right back to that core theme you mentioned. Policy confusion. If the economy is split like this, high service costs, stalled factories, the central banks must be finding it incredibly difficult. They're operating in a state of, chronic indecision.
They really are. And the Federal Reserve is the prime example of this internal conflict. They did cut rates recently, yes, but the committee remains deeply, you could almost say toxically split.
Toxically split, wow.
Well, you've got one camp of policymakers looking at the slowing economy and arguing, we need more cuts, maybe soon. Then you have the other camp waving red flags, warning, hold on, cutting too fast risks, letting inflation flare up again.
And for the listener, trying to understand the market, how does that lack of consensus play out?
It means the market is constantly trying to price in two completely different potential policy paths at the same time. It's exhausting.
So you have to react to everything.
Pretty much. Yeah. It forces traders to respect data points that support either view, which makes these volatility spikes almost inevitable every time a Fed governor opens their mouth or, a single data print like the jobs number comes in off consensus.
And if we zoom out globally again, what's the sort of dual challenge stopping central bankers everywhere from just taking aggressive action one way or the other?
It's what you might call the stability paradox. Services inflation, as we said, remains stubbornly firm around the world, reflecting those sticky wages and costs.
Right.
However, the stability we're finally seeing in energy prices compared to the crisis last year, that's taken the really acute pressure off policymakers. So things aren't getting rapidly worse on the inflation front.
But the underlying stickiness is still there.
Exactly. And that stickiness prevents them from aggressively hitting the stimulus button to boost the weak spots like manufacturing.
So how is the market reacting to this huge tug-of-war between, say, resilient U.S. consumption and global stagnation?
Well, global equities are generally holding up, but it's mostly thanks to the U.S. indexes. They're being buoyed by surprisingly resilient corporate earnings.
And hope for rate cuts.
And the persistent hope for future rate cuts, yes. However, if you look at the technical indicators, they suggest momentum is fading. The market seems a bit exhausted, maybe cautious about breaking out sharply in either direction.
And Europe?
Europe remains pretty range-bound, kind of stuck, predictably capped by that manufacturing weakness we talked about earlier.
Let's turn to the bond market quickly. That often gives a clearer signal. You mentioned U.S. Treasury yields have eased as cuts get priced in. But what about credit risk? Are investors getting worried about companies defaulting?
That's what's really fascinating here. Credit spreads. That's the extra yield investors demand for holding riskier corporate debt compared to safe government bonds. They remain remarkably narrow, surprisingly tight.
And what does that tell us? Narrow credit spreads mean?
It tells you that despite all the worries, investors are not currently pricing in a major economic downturn or a wave of defaults. A wide spread signals fear. A narrow spread suggests confidence or at least complacency about corporate stability and the ability of companies to pay their debts.
So growth might be modest, maybe fragile, but investors aren't bracing for a collapse right now.
Not according to credit spreads, no.
Okay, let's pivot to the final analysis then. Opportunities and risks. If you're watching this very split macro picture, what are, say, 3 clear areas where things could actually get better? Where's the upside potential?
Okay, 3 potential upsides. First, policy support. Crucially, both fiscal and monetary policies still have room to maneuver. They can turn more supportive if growth really weakens further.
The Fed has left the door open for cuts.
Exactly. And in Europe, there's still some room for targeted fiscal spending if things get really bad. So there's a backstop.
Okay, number 1 is policy room. What's the second upside?
Second, energy stability. Compared to the crazy spikes of 2022, oil and gas prices are relatively contained right now. That massively reduces the risk of another acute inflation shock hitting consumers, which is critical for household budgets everywhere.
Good point. And the third upside, maybe linking back to that U.S. strength?
Yes, investment demand. Remember those strong, durable goods orders in the U.S. we mentioned? That's a leading indicator. It suggests businesses are continuing to invest in technology, in equipment. And that kind of investment is what supports future productivity gains, which is really the only sustainable way to generate non-inflationary growth in the long run.
Okay, so policy space, energy stability, and investment demand are the potential positives. But what about the flip side? What are the big threats keeping portfolio managers awake at night? The major downside warnings.
Oh, the downside risks are definitely potent. Number 1 has to be trade tensions. These current tariffs, they absolutely risk retaliation. And that could severely damage the incredibly efficient global supply chains we've built over decades.
Okay, trade first. What else?
Second, labor market weakness. That fading job momentum in the U.S. is a direct threat. It undermines the consumer spending backbone that's basically kept global growth afloat. If that goes, things get much harder.
And that policy confusion we talked about isn't just an internal Fed issue, right? It's a market risk itself.
Absolutely. Policy confusion practically guarantees volatility spikes. Every time the divided Fed seems indecisive or sends mixed signals, expect the market to react, probably sharply.
And any others? Europe?
Finally, yes, fiscal risks in Europe. While Italy's new deficit goal is seen as prudent by markets, as we discussed,
Right.
it leaves very little room for any growth-friendly spending if the economy disappoints further. That puts all the burden back onto monetary policy, which is already constrained.
Okay, so we've covered fragile resilience, policy paralysis, global trade friction. Quite a mix. What does this really complicated picture ultimately mean for you, the listener? What's the key takeaway?
I think the key takeaway is that we're stuck in this holding pattern. You could call it fragile resilience. Growth is undeniably there. It's not collapsing. But it's far too modest, far too uncertain to confidently bet on a clear, sustained move in either direction.
So expect chop, oscillation.
Expect chop. Exactly. Expect oscillation.
And for the listener thinking about their portfolio, how should they navigate this kind of environment?
Well, the analysis really suggests this environment makes it decisively a trader's market, not really an investor's market.
Okay, explain that distinction. What does that mean in practice?
It means that making long-term strategic bets faces really high uncertainty right now. Things could break either way. But short-term tactical moves, maybe driven by those data surprises or policy announcements we talked about, those might be rewarded.
So nimbleness is key.
Nimbleness is absolutely key. Keeping time horizons shorter, respecting technical levels in the market, that becomes critical because it's likely policy surprises and data noise will drive the short-term moves, not some clear underlying long-term trend. You have to be agile.
Agile and nimble. Got it. So, to wrap up, what should be on your actionable watch list? What are the key catalysts that will likely determine market direction in the near term?
Okay, 3 things to watch very closely. First, the U.S. labor market reports job numbers, wages. They are the single most crucial indicator for consumer stability right now.
Number 1, U.S. jobs.
Second, keep a very close eye on European inflation prints, especially services inflation. Is that stickiness finally starting to break? That's a huge question for the ECB.
Okay, European inflation, particularly services.
And third, critically, monitor any developments around those new tariff announcements. Any hint of international retaliation could escalate things very quickly.
U.S. jobs, European inflation, and tariff talk. That's a clear watch list. Well, that's certainly a comprehensive look at the competing macro tensions defining the climate right now. A lot to digest.
Indeed. See you all in the next ProTicker Deep Dive.